Good evening, everyone. I'd like to welcome you to the Hurley Investments midweek commentary for 9/11 of 2018. I've been in thought here most recently. So let me just read to you what I sent out to some clientele and basically have you guys tell me your thoughts, what you think, if it makes some sense to you, because it makes a lot of sense to me. And I'll take any feedback that you can give me. First of all, I said, hello, everyone. Welcome to September and to the worst month historically in the market. The market historically can be down 3 to 7%, usually rebounds toward the end of September, slightly to the end of September, slightly being down 0.5% to 2.8. This is a standard range, and one deviation outside of this drop is a drop of 7% or more. Why? Mutual funds sell their losers to make the fund look better on paper. Sell a few winners to book a profit, and we have a scary October to look forward to as well. What's in October? The start of the nasty midterm elections, a China-based gold-backed currency to trade oil, and a possible interest rate hike if the Fed stays the course. Not to mention we are 5.8 years overdue for a 20% correction, which leads me to my next paragraph. Any comments on that paragraph? Any comments that anyone wants to make? Lance and David, I know normally you say something. Mary, you're welcome to say anything. Any comments? Pretty straightforward. Okay, I'll buy that one. Any other comments anyone wants to make? I seem concerned. Mary, pretty interesting that a woman would notice that. And I mean that in the nicest possible way. Yes, I would be very concerned. I'd be very concerned. And obviously, I think now is a time where you need to be smart about your investments and about new money coming in. Abraham, last phrase means exactly what? Last phrase is just that. We are 5.8 years overdue for a 20% correction. Normally we go through a 20% correction every 4.4 years, and we're behind. We're missing it. There's a correction that should happen that we are way overdue for. So that worries me. It concerns me. Paragraph number 2. There hasn't been a good buying opportunity all year long. We just hit our highs in January and have fallen back down to having the S&P 500 be just under a 6% gain for the year. It's been a very difficult year with such high valuations that don't justify the high market prices. Presidential tweets going out on everything, and a raising interest rate environment that makes the next correction look like it could be worse than 2008. Tax saving has boosted earnings, but it's not the growth that justifies our current market prices. I'm worried, all capital letters, but the correction will probably not happen until next year when company earnings have to beat the previous year, when the earnings that boosted, that doesn't make any sense. Tax saving have boosted earnings, but it's not the growth that justifies our current market prices. I'm worried, but the correction will probably not happen until next year when the company's earnings have to beat the previous year, when earnings that were boosted by 20 to 35% due to the tax cuts. Pretty hard to beat numbers from the previous year when you have to increase in sales equaling the tax cuts. I can tell you now, it will not happen. We'll hear a lot about bringing numbers, estimates, and earnings down. What makes me worried is as I take a peek over the last 9 years, we went through 4 years where there was a 0 S&P 500 growth. Our S&P 500 shrunk year over year. In shrinking year over year, our market was up 86%. When you look at some of the big bears, they are discounting the fact that some of the market grew on very little real growth. It grew on stimulus. Right now, it's growing on tax cuts. Where is the true organic growth in sales? Now, that doesn't mean every company is doing that. You've got Apple and Baidu and, Disney, Visa. There are some that are in there. But overall, our stock market is growing phenomenally. But it's not necessarily going on higher revenues, higher sales. It's growing on tax cuts. It's growing in an area where it's not the organic growth that justifies or increases a fundamental number. And that obviously has me worried as well. So we made it through earnings and a sector rotation to consumer staples. Usually that rotation starts in April. It's where people hide for the summer doldrums. And this year it happened in August. Once again, past history doesn't guarantee future returns. You can see in most portfolios we have added protection to last through the month of October. We started adding our protection weeks ago, and our goal is to make up at least half of the downward movement. It doesn't mean we make up every penny on the way down, because it is impossible to predict the tops and bottoms of the price ranges of equities. Anything, all capital letters, we make on the way down as a profit as investments come back up. Please know we are looking daily at every portfolio. Yes, some have significant amounts of cash that you probably noticed. Some went to work today in Baidu, Under Armour, and Ford. They have hit levels of purchase for the first time all year. And when I say hit levels of purchase, a valuation level, a level that says the expectation is that it'll go higher in the short run. Where am I at? We run probability calculations weekly to find the best probability / valuation to purchase stocks that should head higher. Yes, we use the same research calculations entry points as Warren Buffett. If the greatest investor of all time thinks the market is overpriced and has made a lot of purchases this year, Hurley Investments probably won't be a contrarian investor to Warren. Yes, money will be put to work this month as prices fall to a level that warrant an end of the year Christmas rally run at the end of November. There have been some times here this year where I have not put money to work. I have chose to stay out of the market for some new money due to the fact that, for all intents and purposes, most people don't handle pullbacks or corrections or movement in their portfolios very well. In fact, most people hate any movement in their portfolios. It causes them to worry, to think the sky is falling. Again, in all honesty, 2008 ruined a lot of investors in the stock market. So what about some positions that aren't currently protected? Some have hit levels to take the protection off and look for a bounce higher. Some are stock replacement option strategy that the protection is built into the position itself. For example, you may notice Bank of America, Facebook, or Visa position your account. That is not stock ownership. Some of these symbols have a long call option which acts like stock ownership and makes money as the stock moves higher. This position is 1/10 of the price of the stock ownership, usually, which means being in this position takes 90% of the cost of the stock out of the equation. We lower the risk of purchasing the stock by 90%. These positions are dollar cost average to lower the cost basis and are usually out in time for years. We look for levels of support to add to these positions, which in turn lowers the cost basis, which means the stock doesn't have to move as high as to be profitable. It's a process and at times doesn't make the portfolio look good, but we know what we are doing. Please have a little patience. Give us a call and trust the system. Investing was never meant to be a day trading, quarterly, or even a yearly outlook. Wall Street and investing was supposed to be a 10-year process or more, but welcome to the information age of technology. Know anything we make on the way down benefits you in the long run. Please take a moment today to remember the 9/11 victims. Remember that we live in one of the greatest countries of all time, and when you protect your portfolios to the downside, the returns will take care of themselves. Mathematically, there has never been a more high-risk time to be invested, yet we have the solution to make a major market drop a very profitable opportunity for you instead of a nightmare. This was my position that went out to my clientele. This is my best example trying to help people understand just because you have new money, just because maybe not all of your portfolio is put to work, doesn't necessarily mean that's a bad thing. It's kind of funny. I've been able to come awfully close to meeting the S&P 500 in portfolios with maybe only having 54% of the money at risk. Does that mean I could have made even more money and had an 11.2% return and a 11.2% return and a 6.6% S&P 500 growth? It does. But what it means is it makes no sense at this point in time to be finding a place to put more money in. The market is so overpriced by a valuation metric, by historical growth, by being so behind the curve for a correction at all-time market highs, with companies making less and less in real revenue, that boy, I sit back and I look at some people that are putting money in the market right now, and I just, as I ask questions, I am stumped at the stupidity and the lack of understanding of how a stock market works and how you would buy low and sell high. I have never been more worried on our stock market due to the fact of how people right now are throwing money into the market and what their expectations are. I am okay. I'm 100% okay with not placing money into the stock market right now and letting people just hope that that things will just be happy, that they're not going to take a significant hit in their portfolio, that they're going to make a smart choice when it matters most in making money in the stock market. Any questions in regards to, or any comments in regards to what I just printed out or shared with you? And I think, Gary, you were there this morning. Any comments on this side of what I'm looking at and what worries me? Let me give you guys this. Oh, there you go. So would I do with new money? In all honesty, Lance, right now, I would sit on the new money. I would look forward to finding an opportunity to put it into something. If the market takes a 7% correction, I think a 7% correction or even a 5% correction is where I would start to nibble. That's where I would start to look for opportunities to put some money to work. Or I might also consider waiting until the next earnings event, the next earnings cycle starts. Yes, you can create a low risk or a almost a no risk trade using way out in time, short calls and long puts. I just at this time, I just don't see the benefit of being able to, I just don't see how that's going to benefit an individual in the long run here or through the next couple months. I think September we have the sell-offs. I think in October we have the rate hikes and the start of our earnings cycle towards the end of October, and then we have midterms in November. So a lot of risk. I wouldn't necessarily sell out of anything, but I would definitely not be putting new money to work here. Vernon, great comment here. Rising market on tax cuts. How about adding long-term effect of huge stock buybacks by companies? Yes. As I spoke about that last week or 2 weeks ago, we have like $1.3 trillion of stock buyback opportunities here in the near future. Just meaning there are a lot of opportunities for stock buybacks to propel our market higher. That doesn't offset the risk that's in our stock market right now. Yes, that could push it forward. I'm not discounting that, but that doesn't affect the risk that sits out there in any stock ownership positions. So, Abraham, I do get your concerns, agree with the perception, would follow very closely the VIX and other indicators that might suggest a drawdown is about to happen. Of course, before that, a plan for the situation is needed before it happens. So I would almost agree with you there. But what's the problem with relying on the VIX or any technical analysis? What's the problem with relying on the VIX or any technical analysis for that matter? There you go. Good answer, Mary. Correct. Any technical analysis, the problem with it is that it is past information. It is a past indicator. When you look at the rise in the VIX, it's already happened. Your VIX doesn't necessarily give you a perception, or any indicator for that matter, doesn't give you an accurate perception of the future. It tells you, hey, it kind of held here. It might do this. It can do that. But in any of our flash crashes or even the start of some of our ugly downturns, the VIX was, not that it's a non-issue, because that's not what I want to say here, but the VIX was a post indicator. By the time you saw the VIX and it gave you where it was for that day, the move had already happened. So I'm not sure I believe any indicator is predictive. I think it all takes past information, and that past information is then shown to you in a VIX on a chart, something along those lines. So I'm not as confident in an indicator because that indicator is based on past information. Now, on the second part of your comment, Abraham, I agree 100%. I think you do need to have a plan in place. And for Hurley Investments, on a lot of positions, I've got some cash. So I'm looking in my leap long calls on Visa out to January 2020, Bank of America, January 2020, June of 2020 on Facebook. I am looking at some type of opportunity to be able to use the I don't know, to be able to use this pullback into some type of advantage for dollar cost averaging, to have long puts in place for some of my current positions to see if I can't pick up more shares. There's a lot that I'm looking at to use as an advantage here, but I'll be 100% honest with you. I don't see, because it could go up, because you guys are exactly right. It could go up. I can't be strictly in a long hope position. I got to have some protection for clientele. All righty, what else do we have? In November, new 2021 leaps will be available. Very true, Abraham. But I'm so far out there in time that I think I'm okay doing nothing more than dollar cost averaging where I've been at. That really does help me out, and it'll help some of my positions that I'm currently in. With that said, I do spend some time conversing with Jeffrey Dunyan of Safe Option Strategies, and our adjustment for that Amazon in the money bull call gave me an opportunity to roll down my entry point. So I should, where did I put that though? I think I stuck that. Where am I at? I need my other one. There we go. My Amazon in the money September bull call that was placed at that beautiful price of 195 2000. Nothing like seeing the stock drop $70 below that 2000 short call. As Jeffrey and I were looking at numbers, for $1 you could roll down your in the money bull call to a 1950, 1955. When I work all my numbers, I'm in this about $4.40. I do want this to expire at the maximum return. That's counting commissions. So it does give you the opportunity to make as much as 60 cents on this trade. Abraham came up with another idea: a stiff drink, a whiskey, or a caprina to warm up. When everything goes to pot, take a drink, right? I like it. I don't know how to say it. You just got to be smarter. You got to be smart, and you got to be ready for some things that might occur that you maybe aren't necessarily prepared for. But pretty amazing. We can roll the whole position down. Most of mine are in 10 contracts, so I just grabbed this one here to show you. Pretty amazing to be able to roll in the money bull call down $45 and still be able to make, 60 cents or so on your position. Good place to be in. But yes, I did roll down my in the money Amazon bull call that I had talked about. Was rolled down. It's in a good position now, and it's pretty nice to see the ability to adjust. I cannot wait to see some positions just done and out with. September can't end quick enough for me. I will most likely want to let this bull call expire. I will not close this down at a 40, 50, a 20% return. I was looking for a 20% return or 66 cents. Now the most I can make on it is only is really only 60 cents. So I'm going to let this one go to the very end. That's my expectation on the in the money bull call on Amazon. Which means I need to wait till next Friday to get out of this trade. And that doesn't mean I might get scared out of it. To be honest with you, I could very easily see myself scared out of it. Scared out and just saying, you know what? I'm going to take a little bit of profit and we'll see where we end up. Things are not, I don't know. It's really an awkward, weird market to be in right now. So, with that said, let me bring a couple other comments into place here. What's happening this week and why? We are held to macro news moves our markets daily, which means we are becoming more of a I don't know. What am I trying to say here? We are becoming more of a global economy, or the dollar, right, has more importance than you know. And the short answer is I can just make this comment pretty simple and pretty easily here. It's scary. The rest of the world is on fire right now. I was trying to talk about this. I was going to talk about this today, but I don't have the information. I don't have enough information to give you the what I was looking for. So I will do a better job next week. I'm going to go over this, the world economy and world markets, where you can kind of take a peek and go, oh my gosh, things look awful out there. And they do. I do think our markets will go lower this week. No questions asked. The Dow Jones Industrial Average still is maintaining a bullish technical stance, I guess, even though the MACD, the preceding indicator, does show that our markets could be heading bearish. Same thing with the S&P. Still signals bullish, even though the MACD is our first crossover. And we just slightly dip below, which means technically the S&P 500, if you got all the crossovers, were technically bearish. So it'll stay in a bearish range until the MACD and the 5 and the 20, the 15 and the 30, whichever crossovers you do choose to use, until those crossovers will come back over. Obviously, there's been some more growth in the year in the what do we call it? In the NASDAQ composite. So that's where more people will take their profits from. As I continue to go through here, earnings, Adobe and Kroger report on Thursday. I still am going to tell you right now, I would believe that the stock market will close 2% lower in September. Nothing international that stands out to me. We do have inflation Wednesday, Thursday, nothing to really worry about. Friday will be the day that you'll see a lot of numbers looked into. Retail sales, Michigan sentiment, industrial production, capitalization, business inventories. Most of my positions are still the same, and I've got quite a bit of information via emails to send out to you. I just haven't put it into today's position, so I don't have them ready for you today, but I will have that in so that when you do look at it, you'll be able to see it come here. I guess the short answer is as soon as I get this posted for you. So with that said, any questions that I can answer for you tonight? 36 minutes into it, my short answer is be wary of the stock market. Any questions you'd like me to go over with you tonight? You can find this on Hurley Investments and My Hurley Investment. I'll do the best I can to get this out to you. It probably won't be out until tomorrow afternoon. But I do, in fact, if I can take the time with you while you're here, a couple of the things that I saw. I loved, and I'll get to that here in a second, Abraham. I loved the fact that for the first time in forever, I see a big brokerage house say, you know what? We made a mistake. We made a pretty good mistake on Apple. And it can definitely run faster and farther than what we thought. So because of that, we're going to, we're going to readjust our numbers and say, hey, Apple has a lot more growth than what we thought. In fact, it even went so far as to say, hey, it's wrong by 20%, which I found very interesting because rarely, if ever, will you see any analysts ever say, oh, by the way, I'm wrong. It just doesn't happen that way. So pretty interesting article. I will make sure I'll have that in here. We have 2 more questions. Which sector do you think will be the first to dive down? I think it'll be technology, and I think it'll be technology because you've had such a run in it that's where you'll see people want to pull their profits. So technology would be my thought on what will most likely take the biggest hit, and you'll see a rundown quicker than everything else. With that said, it also would not surprise me to see, for all intents and purposes, I would expect to see financials make the biggest run here in the near future. They just haven't run like they're supposed to. So definitely, in my opinion, expect to see financials be able to make the biggest moves for you or gains into the end of the year. As I took a peek at some of the newest comments that came out, and I have it in here somewhere, there is an article that basically says, hey, look for technology, healthcare, and financials to be the big movers over the next 6 months. And I don't know if I would, well, I just know that I haven't seen financials move like they should. So there's a lot of opportunity still in the financials. Maybe that is a contrarian call. Mod, it could be, but the numbers are stacking up that say otherwise. So yes, it very well could be a bit of a contrarian call, but I wouldn't count on it. I just don't see things turning that way right now. But yes, the good part is, Mon, if I can give you a little comment there, the legit thing is when you're trading or investing, it would be foolish to not take a look at both sides of all the stories. Both sides of all the stories, and looking at contrarian calls and, well, what about this? What about that? Yes, use everything you have to make your best educated guess on what's going to happen, and then move forward from there. Always look at both sides of the story. Always calculate your own numbers. Don't trust the garbage you see online. That's garbage. Trust it as long as you can validate it. If you can't validate it, think twice about it. And here's that comment where the next 6 months or so, we see the growth in the 3 sectors of technology, healthcare, and financials. Any other questions you guys would like to ask? Where's my other one? Just a little interesting how much money corporations have made. I found it a pretty interesting article on the chart on how much cash has been brought home since the tax cuts. And pretty interesting chart. Let me put that one in here. Oh, come on. Short answer is In the first quarter alone, multi-enterprises brought home about $300 billion of the $1 trillion held abroad, according to the recent Reserve Federal study. A good chunk of that repatriated money went to share repurchases. $55 billion was used on buybacks, double the $23 billion in the fourth quarter of 2017. Really, there should be about $1 to $1.2 trillion that comes over. The Fed estimated $2.5 trillion, which is kind of all the money. But obviously, some companies are not going to repatriate all their money. So it does make a whole lot of sense. And yes, Maud, stock buybacks are definitely elevating stock prices and elevating the market right now. If you look at a week or two ago, I thought, boy, that really moves the market higher.